group case, whole market foods, part 7. This is the ratio analysis. The gross profit margin ratio, the industry was at 23.10%, the company was at 34.29%. The gross profit margin ratio is calculated by dividing the gross profit by sales. This ratio shows the percentage of revenues available to cover operating expenses and yield a profit. In the case of Whole Foods Market, we see that Whole Foods are operating above the ratio of the industry. This means that Whole Foods has enough revenues to cover operating expenses and yield a profit. The operating profit margin ratio of the industries was non-applicable, but the company was 3.54. The operating profit margin ratio is calculated by dividing operating income by sales. This ratio shows the profitability of current operations without regard to interest charges and income taxes. Also, this ratio shows how effectively the company uses its assets and manages its operations. The net profit margin ratio, the industry was at 1.5% and the company was at 1.83%. The net profit margin ratio was calculated by taking the profits after taxes and dividing them by sales. The ratio shows after profits per dollar of sales. According to the analysis, Whole Foods is operating above the industry average. This also shows that Whole Foods Market is making a profit on per dollar of sales at a higher rate than the industry. The return on assets ratio, the industry was at 9.7, the company was at 6.63. The return on assets ratio was calculated by using the net income and dividing it by the total assets. This ratio measures a company's earnings before interest and taxes against its total net assets. The ratio is considered as an indicator of how effectively a company is using its assets to generate earnings before contractual obligations must be paid. Whole Foods Market is below the industry average. This means Whole Foods are not managing its assets as well as they should to generate earnings. The return on equity ratio, the industry is set at 23.5%. The company is actually operating at a 9.02%. The return on equity ratio is calculated by taking the profits after taxes and dividing them by the stockholders' equity. This is an amount of net income returned on percentage of stockholders' equity. Return on equity measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. Whole Foods Market is below the industry average. With the money the shareholders have invested, it is safe to say that the company is not generating a profit from its investments. The current ratio. The industry was set at 3%. The company is actually showing a 1.54%. The current ratio is calculated by taking current assets and dividing them by the current liabilities. This is a liquidity ratio that measures the ability of a company to pay back short-term obligations. Whole Foods Market is below the industry average. This means that Whole Foods would not be able to pay back its short-term obligations. However, since the ratio is above 1, Whole Foods has the means to pay back some of its obligations. If the ratio were below 1, then Whole Foods would have even bigger problems. The quick ratio, the industry is at a 1.10. The company is at 1.09. The quick ratio is calculated by subtracting the inventories from the current assets and then dividing by the current liabilities. The quick ratio measures the company's ability to meet its short-term obligations with its most liquid assets. Looking at the industry's quick ratio and comparing it to Whole Foods market ratio, we would conclude that if the short-term obligations needed to be paid off immediately, Whole Foods Market would not be able to meet this obligation. Um, we have the debt to asset ratio. The industry is operating at a 50.7%, and the company is actually showing a 46.06%. The debt to assets ratio is calculated by taking the total debt and dividing it by the total assets. The debt to assets ratio measures the extent to which borrowed funds have been used to finance the firm's operations. Companies with a high debt to asset ratio are highly leveraged. If the creditors demanded payment today, then the company would be in danger. Whole Foods Market ratio is below the industry average. They would be able to cover their liabilities if the creditors demanded payment today. Debt to equity ratio. The industry is showing a 1.03%, and the company is showing a 1.07%. The debt to equity ratio is calculated by taking the total debt and dividing it by the total stockholders' equity. This ratio shows the balance between the debt and the amount that stockholders have invested in the enterprise. A high debt to equity ratio means the company has been aggressive, conclude that if more money was needed to finance operations, it would be harder for the company to prove that they can handle newly acquired debt. Long-term debt ratio. The industry is showing a 0.40. The company is actually showing a 0.65%. The long-term debt to equity ratio is calculated by taking the long-term debt and dividing it by long-term debt plus the stockholders' equity. The long-term debt to equity ratio measures the firm's ability to apply for credit. It indicates that it indicates the percentage of capital investments in the enterprise that has been financed by both long-term lenders and stockholders. With a lower than average ratio, the greater the capacity is to borrow additional funds. Whole Foods Market is above the industry average. This shows that Whole Foods Market has an excessive reliance on long-term borrowing. Though this shows a lower rating, of credit worthiness in the eyes of the creditors. The inventory turnover ratio, the industry is showing a 13.51%, and the company is showing a 16.99%. The inventory turnover ratio is calculated by taking the cost of goods sold and then dividing them by the inventory. This ratio measures the numbers of inventory turns per year. Low turnover rates may result in overstocking. Whole Foods Market is above the industry ratio. This is good because we are dealing with fresh foods. The inventory needs to be high to provide the customers with the freshest products available. Total asset turnover ratio. The industry is showing a 5.13%, and the company is actually operating at a 2.12%. The total asset turnover ratio is calculated by dividing sales by total assets. The total asset turnover ratio measures the ability of a company, to use assets to efficiently generate sales. Whole Foods Market ratio is below the industry average. This means that Whole Foods Market could be experiencing sluggish sales. The company is not using its assets efficiently to generate sales. Fixed asset turnover ratio. The industry is showing a 15.31%, and the company is actually operating at a 4.23%. The fixed asset turnover ratio is calculated by taking the net sales and dividing them by the net planned property and equipment. This ratio measures a company's ability to generate net sales from fixed asset investments. This is specifically targeted towards property, plant, and equipment. A higher Fixed asset turnover ratio shows that the company has been more effective in using the investment in fixed assets to generate revenues. Whole Foods market is below the industry average. This shows that Whole Foods market is ineffective in using its fixed assets to generate income.